All right, so we're going to continue our discussion of sort of innovative strategies. And today I've got Seth, and I want to hear from Harumi. And I also had Sam. So let's get started with you three. So here's really what I want us to make sure that we address. One is, here's Merrill Lynch. They're sort of a major player in financial services industry. E-Trade comes in to the market, and the question is, how should they respond? Or should they respond to E-Trade, right? There's also Schwab, which I think we also want to sort of look at how Schwab should think about responding to E-Trade, because Schwab is actually, before E-Trade came in, they were the discount broker, right? So what do you do when your value proposition is we are low cost, we are the discount broker, and someone comes in and says, you were the discount broker, right? But now we're the discount brokers. And so there's a sort of question about what did they do, what can they do, how should they think about responding as well, all right? So, so Seth, I just want to jump, today I just want to jump right to the, how would you think about advising Merrill Lynch to respond to E-Trade?
Yeah, so we talked a lot in our group about whether E-Trade was a disruptive technology or sustaining technology. We think that it was disruptive if you look at it from Merrill Lynch's standpoint, and that they did kind of the flat fee in the online trading, but it wasn't really disruptive if you look at it from Charles Schwab's, because they were already doing the flat fee, and they did online trading pretty quickly too when it started.
So if you're saying it was disruptive for Merrill Lynch, number one, what's your criteria for it being disruptive? What made it disruptive to Merrill Lynch? Did Merrill Lynch, just customers, flock for the new offering? Is that what made it disruptive?
It was disruptive because it tapped into the lower end of the market.
Okay, but the question is, did it actually disrupt Merrill Lynch? In other words, doesn't it have to actually hurt you in order to be disruptive to your company? What do you think?
No, I don't think it does, because I think that the definition of disruptive technology, you go for the lower end of the market that the giants don't really care to fight you for.
Okay. But so this is an interesting question. Let's say a new entrant comes into the low end of a market and you're an incumbent. Your customers never leave for the new technology. Is it disruptive to you? What do you think, Austin?
Yeah, I mean, we talk about Honda and Harley. Like, Honda was extremely disruptive because they came in.
But that was because they actually went after Harley's customers at some point, right?
But later on, right? So
later
when
on.
they first came in, Harley wasn't worried about it.
So do we know whether this is disruptive?
I think it is.
You think it will be?
Yeah.
The question is, is it disruptive, Parker?
Well, Merrill Lynch is making changes, right? So like they're changing their strategy because of it, and they're scared, and their stock's dropping. So I'd say it is disruptive because it's disrupting their strategy. They're changing because of it. They're not changing because they decided, hey, I think it's a good idea.
So if the incumbent has to change
Yeah.
something because something new's come in, you're saying, I think that's a good criteria definition that something's disruptive if the incumbents are actually changing or responding. If they don't, so the Tata Nano has come in at the low end of the market on cars. Is BMW or Lexus, are they, Mercedes, are they changing what they do? Is it disruptive? I don't know, maybe it could be, right, if they move up, Phil?
The key is that Merrill Lynch didn't do anything because their temptation is to flee up market, right? Because they have their customers, and the low-end customers are low margin. And so they don't want to focus on beating the new entrants there because they would lose profits doing it. They can move up market, and looks much more attractive.
Why would they lose profits doing it?
Because the new entrants come in and they are willing to make a smaller margin. They use a different business model or something like that to achieve the same profitability, and for them to match it, they have to actually lower their, like, make lower returns.
Okay,
They
so-
want to move up market. They wanna-
Okay, so there's this notion that if they tried to go after the low end of the market, they would not be as profitable because it's a different business model for the low end. So why don't we take just a moment, let's try and see if we can understand, look at what the business model is, what the strategy is for Merrill Lynch compared to E-Trade. Then we'll get back to the issue of what do they do. If you think it's disruptive, then the question is, well, what are their options? What are my options for response if I'm an incumbent, right? We want to lay out the options. This is typically the way we want to think about good strategic decision making is, let's lay out the options. We look at the pros and cons of each option, and then we select the option that we think is going to give us the best result. Okay? So, let me move to, so Harumi, let's go to Merrill Lynch and help me to understand their strategy, their business model. Phil was saying that it's different from E-Trade's. Let's start with Merrill Lynch's and understand what Merrill Lynch's is. Then maybe I'll jump over. Sam, you can help us understand what E-Trade's is. And then we may even look to see how Schwab's is even different than the two of them, and then we'll look at response options for Merrill Lynch and for Schwab.
Okay, so Merrill Lynch is one of the biggest players. They work with the clients and investors that kind of push forward stocks, and they work with brokers. So it's a personalized assistance, and they don't charge a flat fee, but they do commissions.
Okay, so they do commissions. So walk me through, if you can, let's use our framework. Walk me through their strategy in terms of the, right?
Okay, so the market is the high net worth investors.
Okay, so they're focused on, so we know their financial services broadly, but we know financial services, and you're saying really the segment they're focused on is high net worth investors, okay? Good, so they're focused on high net worth investors, okay?
And the unique value they offer is their brokers, because they are very knowledgeable and they can give good advice to investors.
Okay, so if I'm an investor, I go to Merrill Lynch because I get this sort of high-touch service, and I think I'm getting good advice. So I want advice on how to invest, and I feel like I'm getting high-touch service.
And Merrill Lynch has also been around for 100 years, so that's probably another thing.
Okay, so there's some sort of this notion of trust and reliability that might go with it. But so the value here is this is really a differentiation strategy, right? You'd probably say certainly not low cost. And how do they differentiate? They've got sort of high-touch service that gets provided by these brokers and advice, right? So this is your financial advice that will help you at the end of the day. This will give me a good return, right? So I'm a high net worth individual. I want a good return. I want you to tell me how to get my good return, and I want it to be convenient and easy. Very high touch. That's sort of the value. Okay, and next?
Then to resources and capabilities, they have all the knowledge and all the brokers, and that can be a resource too.
Okay.
And also their customer base, because they have a significant amount of customers that dominate around 4% of the assets in the US.
Great. So if we think about each of these, so they have this set of brokers. Do we know how many brokers they have, roughly?
It's around
15,000?
Yes.
Okay, so they have 15,000 brokers. These are the guys and gals that are providing high-touch service, right? And then they also have, you mentioned, an installed base of customers, right? Installed base of customers that they've built over the years, and there's sort of this notion that they've built some sort of brand equity around investment. What other resources and capabilities do you think Merrill has?
It's just trust, because customers
Okay.
trust them a lot and they're not going to switch to someone else.
Okay. So this is also related to their value proposition. You can sort of trust that you're going to be taken care of and you're going to have a good return. The rest of you, any other resources and capabilities that you think Merrill Lynch has that are worth?
Well, I don't know how international Schwab and E-Trade are, but I know that, for example, one of the 6 facilities for Merrill Lynch is in Japan. I mean, they have a big presence internationally.
Okay, so they're international. Do they actually have people trying to figure out what you should invest in? So they have research, right? So they have, does E-Trade have research?
No.
Yeah, so E-Trade does not have any research. So they actually invest in research in order to help you. This is what drives the financial advice that they give you, right? They send that out to their brokers. The basic ones are, right, buy, hold, sell, are the sort of 3 things for given stocks. We know that that they have not only 15,000 brokers, but we know roughly how many branches they have. Say how many? I'm not sure if it says in that article or not. 6 main, but as far as branches around the U.S., I think at this time they had something like 1,400 branches. I think there were roughly like 10, 11 brokers per branch or something like that. But something like brokers, and the issue is of a branch is, why is a branch valuable? Yeah, it's close. It gets you closer to your customer. So they want to be able to go into an office that's close and convenient and be able to talk to somebody. So 15,000 brokers, 1,400 branches. They do a lot of this, a lot of the research. So that's sort of the way they win in the marketplace, right? All right, so Sam, contrast that with E-Trade.
Okay, so E-Trade kind of had a completely different business model. They're more electronic. They're like an online discount stock brokerage.
Okay, so if we were thinking about their markets, how's it different?
They target more kind of like the low end, like we were reading about.
Okay, so they're also in financial services, but they're looking at the low end. I don't know. I don't think I want to describe myself as a low end person.
Not high net worth.
Not high net worth. Okay. What's that? What? So,
I think it's
John?
also people that want to have more control over their trade.
okay. So it might be people. You think it would be people who typically have less money, right? Have less net worth. But they're people who want more control.
That think they can do it by
Yeah,
themselves.
yeah. So you might think about it this way: E-Trade is the Home Depot of financial service. It's for do-it-yourselfers, right? I mean, think about it. Isn't that really what they try and give you the tools? And it's like, all right, now you do it yourself, and that makes it a lot cheaper.
I was just gonna say, you don't have the knowledge that comes with. You're not asking for advice. It's just a bare bones. If you want to trade, you can come do it. Yeah, do it yourself. It's not like we're gonna give you this advice. I'm gonna tell you how to do it. We're not gonna do it for you. For those that want to do it themselves, that have the knowledge, here's the easy way to do it, so you don't have to jump through hoops with some big firm.
Okay, so we're going to say the markets they're focused on is financial service, but it's more the lower end and for do-it-yourselfers. Richard?
And I was thinking the way they would put it is maybe not lower end, but we're intending for the more knowledgeable customers. The customers who already know what they're doing. They don't need to pay for someone to give them this points advice.
Okay, so it's also the do-it-yourselfers include the sort of savvy investors that I can do. It's hey, I don't need someone else to figure out what to do. I can do it and I want to do it.
I feel like the flip side of that though is they also target starter investors who don't really know what they're doing because it is such a cheap option to trade. They even start you off with several free trades in the beginning. And
Okay.
so the majority of people I know who use E-Trade do it because it is so cheap.
It's a way to get started.
Yeah.
Yeah. Okay, so now let's move to value.
Well, we were talking about in our group about this actually for resource and capability. You said it's kind of the do-it-yourself. Andrew said in the previous class that they kind of avoid the middleman instead of referring to instead of referring to the dealers, they just go straight to the market. So I'd say that's basically a pretty big resource for them, that they can just avoid that, take out like a piece of the value chain and avoid kind of that cost.
Okay, so if we think about why do people choose E-Trade? Cheap, right? So this is your low price option. So this is a cost player. And then, so let's look at then your issues of how they do it, how they deliver it. What do they have to be good at and how do they do it?
Well, they obviously can target more people because they have technology and the internet, so they can reach more people. They
Okay,
have that.
all right, so that means what do they have to, in terms of resources and capabilities, what do they have to be good at in order to succeed? This ability to target more people, they can do it over the internet. What do you have to be good at? Marketing, but just, I mean, how many?
Building an internet presence.
So you got to be good at marketing, building an internet presence. I mean, in some ways, if you had to choose between Merrill Lynch and Amazon.com, and you were going to hire people to be successful running E-Trade, which company would you want to hire from? Yeah, probably Amazon, not a company that's in financial services. Why Amazon? Because
They're really good at building that presence.
we're trying to have an electronic relationship with our customers, right? So Amazon's good at having an electronic relationship with customers. So you've got to be really good at website design, right? You got to make this easy to be able to navigate, because you know, investing in that is a fairly complex thing. So if you think about what they have to be good at in terms of resources and capabilities, these guys have to be really good at technology and software in particular. Writing software is going to be a very important skill. Marketing. You mentioned they got to be good. Yeah, if you don't have branches out there, if you don't have stores, the question is how do you let people know? So it's either got to be digital marketing or what's the other way that they tried to reach customers? I mean, how many of you have never seen the E-Trade baby? Right? The E-Trade, what's the point of the E-Trade baby? What are they trying to convey? This is easy. It's so easy, even a baby can do it, right? So I think probably pretty much everybody in here at one point in time or other, you've seen the baby commercials. You sort of get the point. So they have to be good at digital and media advertising and marketing.
They said as a result, they had a 30-second clip during the Super Bowl. I kind of just looked this up.
Mhm.
They said as a result, in 2013, they had 64 million total views after that ad.
After the ad. 64 million views.
And it said they got 26,000 subscribers on YouTube and 108,000 Facebook likes.
Okay. So that, if you can translate the $1 million that they probably spent on that 30-second spot into, I'm sure they probably feel like you get enough customers that then come in and stay with you and you make money on them over time, it's worth it. You know, you have to do all of those calculations. So they got to be really good at technology. They got to be really good at digital media. What else do they have to be good at? Yes.
I think convenience would be a big one as well. Based off of, I mean, instead of working through all these people, you kind of feel good about doing it yourself. You're kind of like, oh, I'm the man, I'm doing this the right way. You know what I mean?
So how many of you have ever traded through like an E-Trade? How many of you want to be able to at some point have some money to trade? I understand. So a couple of you, who has? Okay, so we'll just ask. So Blake, Sam, Curtis, did you find that it was easy to navigate?
Yeah.
Pretty easy to navigate. What did they give you any tools to help advise you on what to invest in?
Well, I've used E-Trade just a little bit, but I mainly used Trade. So I trade a lot, but I haven't used E-Trade a ton.
Okay.
So I'm probably not the best one.
So how do you? The question I have is, how did you know what to trade in? How did you know what to buy or sell when you did it?
I did my research separately. I didn't use.
You didn't use their tools, but they had tools to provide.
They did. They have some tracking stuff. They have some alerts and that sort of thing to let you know.
Okay.
You know, give you. I want to know when it hits this point. Let me know so I can trade it. But I didn't use
You didn't use those. So you did sort of separate research to figure out what to invest. You did separate research. So so this is the notion again. We're appealing to do-it-yourselfers, who for whatever reason know why they want to invest in whatever they're trying to invest in, and they're making that choice. They do pull in from like Morningstar. They pull in from these public sources of sort of analysts and make that public stuff available. So I think one of the other things in terms of convenience, one has to be in terms of navigating the website and be able to do the trades, but also to access advice, right, or analysis on what your choice should be. And we see this now in lots of websites now. You go to Netflix and you select a movie, and what do? They give you they give you all these other ones that you might want to try, right? And if you go to Amazon and you buy something, they're going to also give you the also like. So they're going to try and give you advice on what else to buy. Yes.
I think E-Trade also takes advantage of kind of piggybacking on other financial resources. Like these guys, they did their research in other places, and then they went to E-Trade because it's the cheapest place. It's kind of like 1-800 accuracy.
Right. So in some ways, they can kind of free ride, sort of like 1-800-Mattress a little bit, on research that's done by others that becomes publicly available. But that means you do have to have a capability to go out there and search, to find advice that you think might be good and credible. You have to do some screening of it. You can't just give them anything. So you do have to have some screening capability to be able to do that. Andrew and then Chris.
I think there's also another way to look at E-Trade. I'm in the financial economics class, and we talked a lot about how E-Trade doesn't just have a client base that's consumers, but they also sell data analytics to their dealers. So the way that they make purchases is that people make purchases through E-Trade, and then they go to a dealer, and then the dealer does the market trade, the actual stock trading. And E-Trade works on both sides. And so I guess that would be kind of a resourcing capability that they've exploited, the fact that they can sell their user data to the dealers as well as make trades. And it's fascinating because E-Trade has built a company that is based on making very small margins, but millions of times a day, that allows them to make money from both ends of their business.
And if you're capturing everything electronically, you have the data. You know, this is where it was really interesting. Amazon had been in business for 5 years, and they knew their customers and their preferences much better than Barnes & Noble did, who had been servicing them for 20 years. Because, you know, it's a lot different when someone comes into a store and buys a book, and you maybe have a history on them, you maybe don't. Whereas Amazon's capturing not only what they buy and able to pull that together and see what else they buy, but also they can actually even watch what you click through and, you know, the things that looked interesting to you. So they have a lot more information about the preferences of customers, and you're saying that they can sell them.
So we're seeing all this stuff as resources and capabilities, as convenience and free riding on research, but actually it might end up being sort of a disadvantage for them because, like, you know, we said we have basically no loyalty to E-Trade. It's just because it's a low-cost provider right now, and new options are coming out. There's motif investing where you can get a basket of stocks for 1 commission, and there's also Robinhood's coming out. It's got no commission. So as soon as they lose their low-cost advantage, then all of these things that are making them, you know, that are resources right now, end up.
It raises a question about barriers to imitation. How sustainable is this, right? Well, of course, there's issues about how sustainable is what Merrill Lynch does. And if we think about Schwab, Christopher, how would you describe Schwabs? How are they different from either Merrill, based upon, there may not be much there.
Yeah. They're going to lose the flat rate, right?
They went with the flat rate. It was cheap, but not as cheap, right? So what was the price of a trade here?
$14.95.
Okay, so at the time, $14.95, just so we get a sense of the relative pricing. Schwab? Okay. 29. And Merrill Lynch?
1%, but they also went to $29.95.
So they went and they matched. They ended up matching Schwab. So what do we expect is going to happen with Schwab? They're going to go below Merrill Lynch, right? So, so we know they're doing something a little different from Merrill Lynch, and they're doing something a little different from E-Trade. Anybody ever worked with Schwab? And I just picked on you at random, Christopher. I don't expect you to necessarily know anything about Schwab, but as we sort of think about it, anybody who's used Schwab, TD Waterhouse is kind of like Schwab, a bit.
Yeah.
So how's Schwab different from Merrill Lynch or E-Trade?
Schwab is kind of like a hybrid between E-Trade and Merrill Lynch. They have people that are waiting on the phone to be able to give you a little bit of advice, even though they don't counsel you exactly.
So they have advisors that will advise you, or I should say, they call them advisors, but they actually don't advise you.
They don't advise you.
They give you data,
Yeah.
but they are instructed that they are not to advise you. They're just supposed to give you, if you want the 5 mutual funds that are value funds or international funds, I want the 5 that have the best returns over the last 5 years, they'll tell you what those are. And then you could choose. But they actually, don't. And they do this over the phone. Do they have branches?
Yes, they did.
Yeah, they do have branches. Do you think they have as many as Merrill Lynch? Fewer than Merrill Lynch. Next, they have fewer. They have probably 1/10 the branches. I think they had, at the time, they had 1,400. I think they had something like 400 branches. So they do have, and they do have some brokers then at the branch that can give you advice. But it's much smaller than Merrill Lynch. Okay, anything else that's different about Schwab?
Yeah, they really are hybrid. There are some legal things why they can't do advice. It has to do with what they can charge for. So Merrill Lynch is able to do the 1% on their accounts because they're actually set up as financial advisors, whereas if they're just a broker, they can only charge commissions.
Right.
So Schwab, they have people who are advisors, so they're kind of like the poor man's financial advisor. They really do want to be in the space. They want to do the same things as Merrill Lynch, but for the regular Joes.
Okay.
People who have like a 401k or an IRA and just want some advice on it. And they don't want to be just a brokerage because they don't want to compete with E-Trade at just the low.
So they're not the high end, they're not the do-it-yourselfers. But if you look at Schwab's, look at what the tagline is for their advertising over the last few years. Anybody?
Talk to Chuck.
Talk to Chuck. Talk to Chuck. What's with that? No, really. What do you think? What are they saying? Talk to Chuck. What's the partner?
It's just more casual, right? They're trying to appeal to a different demographic. Right?
Okay, so a little more casual. You could talk to us.
I was just say, if I'm at home and I have enough to spend, but I'm not sure I know how to. I hear E-Trade and I think I'm not really.
I'm not sure I want to do.
But I do want to trade. I'll just talk to Chuck.
I'll talk to Chuck. Yeah, Michael.
Yeah, that's just basically what I was going to mention. Just that you have advisors to talk to, so you have someone to talk to, but it's not just online.
What about E-Trade? How does this differentiate them from E-Trade? It's pretty clear, right?
Yeah, as you said before, savvy. You know
Right.
what you're doing.
E-Trade, nobody to talk to. Right? In fact, they don't want to talk to you, and they make it hard. It's not easy to talk to somebody at E-Trade, and we're trying to now tell those investors that we used to be the discount broker. Remember? Now we're not the discount broker anymore. I would say that you could argue they're sort of moving into the value space. Right? We're trying to give you good value. You can talk to Chuck. We're still pretty low price. We're not as low priced as these guys, but I think it's like this is good value. You can still get advice, but it's pretty low cost. Is sort of the way I see them positioning relative to E-Trade and to Merrill Lynch. Because once they were no longer the discount broker, they had to move somewhere, right? And so what they do is they end up moving up market a little bit and trying to be more of a value player for those folks who feel uncomfortable making the decisions on their own, and they want to talk to somebody to get some advice. Yeah.
Just kind of Schwab's idea right now, as far as advertising, I just see ads kind of going on over Wall Street Journal. They just say, lots of people don't have like morals in this day and age. We feel like corporate America's gone awry. But if you know where to look, you'll find it right here at Schwab. Charlie. So, like,
And you can buy a tire on
But it seems like they're pushing for the middle class that's mad at corporate America. They're not just going for just the poor man, but they're going for the middle class.
The middle
that
class.
wants to be able to compete against
Okay.
these larger big companies.
Okay. So now the question comes back, and I'm going to come back to Seth now. So we see these different companies with these different strategies. And the question really now becomes for Merrill Lynch, how do I respond? Or do I respond to this new low-end offering that comes into the market? You could say the same thing about Schwab. Do I respond, and how do I respond? And we've sort of talked about that one of the things they've done to respond is they've actually tried to move up market a little bit and become more of a value player. So it was somewhat disruptive for them, and that's part of what they've responded. What about Merrill Lynch? What do you think what are their options for responding first, and then we'll sort of get at what you think they might do.
Well, so they already kind of responded by switching to a flat rate for $29.95.
Okay.
But one of their options could be to continue to try to respond to the disruptive, so try to cut their rates even more.
So you do this all within your existing business, right? So one option would be, actually I'm going to take, at the far extreme, I'm going to say one option is do nothing, right? One option is, hey, they're going after a very different customer. Those aren't our customers. Go for it. You might hurt Schwab a little bit, but knock yourself out, because our customers are high net worth. They want the high touch service that our brokers and branches provide. They want the research advice. We don't have to do anything, right? So that's one option. This is sort of within your existing business. The other thing is, you're sort of saying you could respond within Merrill Lynch, right? Respond in your existing business.
Right.
So respond by sort of dropping prices.
Right. And the reading doesn't really suggest that. It kind of says that large companies that are incumbents struggle to respond to disruptive innovation in that way, because they're already structured in a certain way, and for them to change is very hard.
So what's another option for them? And this is responding by dropping. So this is basically, you have your existing business that's intact, and we're responding. We either don't respond, or we respond. This is existing business. So keep our existing business the way it is, but maybe we drop prices a little bit. Anything else we could do?
Move up market even more.
And we could try and move up market even more.
You could look at acquiring one of the other two players.
You could acquire one of the new players, either Schwab or E-Trade.
Yeah.
Okay, so I'm going to look at that sort of on the other side of it, is you could say, hey, this looks like a pretty good opportunity, and let's just acquire E-Trade. Maybe they should have acquired E-Trade out the block. So they could acquire the company or companies that they think of as possibly those that are potentially going to be a disruptor. You want to follow on that?
Just a quick question. So we looked at the assets that Merrill Lynch has, and they have 99 million in assets compared to Charles Schwab was 99 billion in assets compared to 21 billion in assets. But only a small portion of that is actually cash, and so you would need like a more liquid source in order to acquire them. Is that right? I just wanted to check if that's what's done in the industry or not.
So there are different ways to try and acquire a firm. Who can tell me in here? I don't expect you to know this. Who can tell me what a typical premium that you pay for a company's stock when you go to buy it? Austin? What's that?
30%.
30% is sort of a typical premium. At least that was sort of the average, during the last decade or so. So on average, you're thinking about, hey, stock price is $10 today, and we want to buy this company. We're going to probably have to pay $13. So you're going to have to pay a premium of $3 a share. Is that a good investment or a bad investment? How do you know if it's a good investment or a bad investment? You're the acquiring company. You got to make that decision, right? How do you decide? It's only worth $10, but you're paying $13. At least everybody in the market today is telling you it's worth $10. But you're saying it's worth 13. Adam?
If you're gonna have an aspect kind of combining the company, will actually strengthen it and build more value.
Okay, okay. This is where this beautiful word synergies comes in. Synergies. If there are no synergies, then you just pay $10 or $13 for an asset that's worth $10. At least the one that everybody thinks is worth $10, and you pay 13, right? If you don't bring something to the table, some synergies, it's either got to be ideas or ways to grow that business faster than it would have otherwise, or that you are able to lower your costs or their costs because you combine operations, or you're able to cross-sell products or things. So you've got to have some sort of synergies in order to make an acquisition make sense. This is sort of a basic concept. So, so you could acquire the disruptor. Andrew, is that what you would do?
I mean, it depends on which one you're looking at, and obviously what you value them. I mean, it would be appealing to acquire a company like E-Trade and build that expertise in the online segment, and then maybe, you know, reconfigure their business model a bit to kind of appeal to the low end of the market.
Okay, Christopher?
Another thing you could do is you could kind of create like a sub-brand for the lower end market.
Okay. So you could actually do, this is what we think of as a spin-off.
Yeah.
Right? This is Merrill Lynch, we'll call it light for right now. But right, that's sort of the, it's Merrill Lynch light. We could create our own separate company, and why would we want to do that?
So, because you don't want the new entrants to take over that space and move upstream, so you have to bring in
So this is a way you create a competitor for the new entrant, go after that same space, stop them perhaps, and now if we do that, we don't have to drop prices in our main core business. We let them do it, and by the way, they need to have a completely different set of resources and capabilities than we have anyway, right? Because if we compare this with this, in order to succeed in this business, you don't want to have brokers and branches and all that other overhead. There's no way you can compete on price. Joe?
And I think that's a great idea because the problems that many incumbents face is that if they move downstream, they're diluting their brand image. For example, like Harley Davidson, if they went downstream to compete with Honda, its image would have gone down. But in this particular case, Merrill Lynch would be able to have this like sub-branch and compete against this disruptive innovations, but still have.
So you might not call it Merrill Lynch Light. You wouldn't want to necessarily tarnish the brand, but I mean, look what Marriott did with Courtyard. Right? It's Courtyard by Marriott. Right? So you might be able to put another brand out there, and it could be by Merrill Lynch, or in concert with Merrill Lynch or something, to at least give it some sort of trust in your brand that gets associated with it. Spencer?
So the big problem that I see with what Merrill Lynch did is they're kind of straddling two different revenue models, and they were going after the lower end, the lower margin customer segment, but what they were still trying to do is they were going to pay their brokers to deal with those premiums they would have received had they continued to deal with the clients that were in person.
And why are they going to pay why don't they just cut what they pay the brokers?
I mean, they've generated their name in Merrill Lynch and hired, 14,000 brokers, and you're changing you're starting a new business essentially. So the reason that I would absolutely acquire is because you're going to have a firm that's already developed the technology. You're not going to be, regardless, you're going to have to downsize your business some because it's frankly it's an industry that's shrinking, but you can still take advantage of the growing.
Is the financial services industry shrinking?
Sorry,
overall?
I'm not sure overall, but I'd say the sale to broker.
The broker to customer part is shrinking. Okay, so here's the so why do they pay the brokers the same? Why, Derek?
Well, the brokers are their key asset.
The brokers have the relationships with the clients. Do you really want to take off 15,000 all of these brokers, right? And at the same time, though, the problem is you just dropped your price significantly, which means you just really hurt your profits a lot. Yeah?
Yeah, I was just going to say that it seems like the brokers are the ones that are the real asset to the company, so you want to still have that incentive for like the best brokers to be hired, and they're not going to want to listen to the company that has like the lowest percent.
Yeah, so what's the quickest way for Merrill Lynch to lose customers? Have the brokers leave and take the customers with them and become independent financial advisors, right? That's the quickest way. But the question really, though, in terms of responding to E-Trade is, so the first question, is this disruptive? At the time this happens, Merrill Lynch does respond, but they don't have to, right? They didn't have to respond. The question is this going to hurt them in 10, 15, 20 years?
Well, I think the question that they needed to answer was whether this disruption was a change in customer expectations that would not just target the lower segments, but span to everybody. Because it said they noted that when people started creating these business models that appeal to lower segments, their upper segment customers started thinking, well, no, maybe it is that, on average we have 300,000 in our account. I mean, based on the data we have.
Right.
Maybe I am being nickel and dimed for services that are actually costing me quite a bit of money when I could get the same thing. Not at the same necessarily rate or at the same value, but based on a similar model that we're using with lower segments.
How many of you have Merrill Lynch? Okay, nobody does, right? Does anybody start with Merrill Lynch? Okay, pretty much nobody starts, because if you don't have at least 50,000, they're not really interested in having you as a customer. So nobody starts their sort of investment career or their financial services career with Merrill Lynch. Where do you start? You probably start here or here, right? Depending on, if you feel like you're a little more confident, you might start here. Otherwise, you may start with over here with a Schwab or a TD Waterhouse or something. That's probably where you're going to start. Where does Merrill Lynch get their customers? Right, yeah. The notion is at some point, these folks are going to graduate from, Schwab or Merrill. It's like, I now have enough money. I don't want to do it myself. I want the convenience. So I'm going to now move it to Merrill Lynch and let them handle it and take care of it. And it's convenient, and I'm still going to get a decent return. I don't have to worry about it. Right? So, I look at, I think about my mother until she passed away about 1.5 years ago. I mean, there was no way she was going to spend any time on her finances. She just wanted to call her broker, who was the neighbor boy, the son of her good friend down the street, who she trusted, and have him tell her, you have money in your account, and you can spend it, right? That's as much time as she wanted to, each year she wanted to basically spend 3 or 4 minutes to make sure she had money in her account. How much, do I have this year? And make sure she's covered. A lot of people, that's all they want, right? So you're hoping that people will graduate, that some people, as they become higher, will move in this direction. What's the danger for Merrill Lynch? Christopher?
I think you can see it is that these other companies are starting to move up. I mean, Schwab started really low, but then E-Trade came in, that market started to get saturated, so they're starting to move up.
Yeah, what happens if these folks start to keep their customers? If they figure out a way to make it easy enough and convenient enough that you don't graduate to Merrill Lynch? The danger is not immediate to Merrill Lynch. The danger is in 10 or 15 years, right? That's really, and this is the way disruptive technologies work, right? They come in, they actually don't take your customers today, but your nightmare is that in 15 years, people are not graduating to Merrill Lynch, and therefore now you don't have enough customers to support your broker and your branch network, and actually that's what we've been seeing the last 4 or 5 years as Merrill Lynch got into trouble, is they didn't have enough customers to support their broker and branch network.
Can you think of other? Can you think of other industries that this same model of innovation has been followed? Because like real estate brokers are really annoying, and if you could just cut them out, like you could cut out.
Okay, now we're looking at cutting out the middlemen, and that's one way to do a new business model. I just want to we've highlighted the problem, the challenge for Merrill Lynch. We've looked at some of the options. Let me just suggest one more option. What's maybe another option that's in between spin-off and acquisition?
You just open your pool, or you just buy the brokers. I mean, you just go hire other companies and take the brokers.
So you've got, but that would be on the high, in terms of acquiring, right?
Yeah.
With your existing business. I'm saying, what's another way you could take an option on the low end, on a low end.
Share some sort of like strategic alliance
Yeah,
or venture.
yeah. So the other way to do it is we say, you know what, we're not going to acquire E-Trade, because one of the things we do know is when big companies acquire small companies, a lot of times they mess it up. Why do they mess it up? Why do you think why do things get messed up? Big companies buying small companies. Yes.
They don't have those resources and capabilities.
Okay, they're not good at that. For one thing, they acquire it, they don't really know it, and what often happens when the founder of a startup gets acquired? Man, I'm off to the Cayman Islands, man. I just made it rich, and I don't have any particular need to grow this business inside Merrill Lynch. So I'll take my money, thank you, and I will move on to something else. So I remember talking to a friend of mine who worked at Bain with me years ago, Meg Whitman. She was the CEO at eBay for a long time. Left, she actually ran for governor of California not too long ago, and now she's the CEO of Hewlett Packard. And I remember her telling me after eBay acquired PayPal, she walked into the office of Peter Thiel, one of the founders of PayPal, and she noticed there was a ticket on his desk to Africa. She's like, oh, Peter, so you're going to Africa? And he says, yeah, there are some new things I want to go explore out there. Not really interested in scaling PayPal within eBay. And he left within a couple of weeks. That's what happened. So what sometimes happens here is you acquire them and they're off to Africa or some other place because they don't have now the motivation, the incentive. So in alliance, you take a minority investment perhaps. This is something that I suggested IBM probably should have done with Intel and with Microsoft. You want to keep Bill Gates there, right? You want to keep Andy Grove and those guys at Intel running it. You want to keep skin in the game, but we're going to come in and we're going to buy 35-40% of your company as an option if this thing takes off. We want to participate in the growth, and we want to use it as an option to explore ways that we might connect what you're doing with what we're doing at some point in the future. Right? So that's another option for Merrill Lynch. Okay, so yeah.
I was saying, I was looking into kind of what is the situation now, and I was looking at Merrill Lynch's page, and he kind of started this Merrill Edge brand name, where I found interesting, they're undercutting all the prices of all the other ones. Like they're advertising $6.95 per trade when E-Trade's at $9.95, so it's almost like after Bank of America acquired them, they're now just going with the idea, okay, we're going to undercut everybody and try to bring in new customers.
So now we're going to play across, the issue is we're going to play across the whole spectrum perhaps.
Yeah.
And if you want to be here, we could offer that. If you want to be here, we can offer that. And that's one of the challenges that they have now is it's hard to get more and more folks to graduate to the Merrill Lynch of old. Okay, so how many of you, now that we've discussed this, raise your hand, how many of you would do nothing? Okay, so now you all think this probably got to do something. Respond by dropping prices, that was probably not hard. How many of you would have created a new company immediately? Just sort of one. So about 18 would have done that. How many would have done an alliance? About the same number, 17, 18. How many would have just acquired? Okay. So what you've suggested is that what you've opted for is something comes into the market. We think it could be disruptive, which means we have either got to replicate it, take an option on it with Alliance, or buy it. What would lead you to buy it over replicate it or Alliance? Yeah,
Depending how scared you are. I think of like Facebook. I mean, they did not need to spend $19 billion for WhatsApp. It was like 1 or 2 billion maybe, but they were scared out of their minds. They were just going to totally destroy their model, so they just bought it outright.
Okay, so if you were concerned that this would that this would lead to a disruption of your core business, and it would happen relatively quickly, then you may just say, you know what, we got to buy it, and we got to buy it quickly, because we're pretty darn sure this is going to be disruptive to our core business, and we would rather own this than have the potential of it disrupting our current business. Okay? Yes?
When we do decisions like that, then we kind of run the risk of making irrational decisions. I'd say that Facebook's kind of decision with firewall and stuff was a little bit, they felt pressure and it was very irrational. I mean,
Yeah, so here's the question. Can you afford, if you're an incumbent, to go out and acquire everything that looks like it could disrupt your business? That's really, do you have that much money?
Google does.
And right now, this is the, Facebook may say, you know what, we're going to overpay for this. And we're not going to be able to find synergies worth this amount. But what happens if they displace us? Over the next 20 years, if we're going to come down, if our value is going to come down significantly, I would rather own this as it comes up, rather than go down and not own this as it comes up. And so some will, again, they will take it's an option on a growth business that could be disrupted. Nathan?
Isn't that kind of what Merrill Lynch did itself? Did they enter in the lower price strategy and move up market as well?
They did move up a little bit in terms of the brokerage. They ended up being sort of one of these higher end brokerages. And I think originally they weren't like one of the sort of the elite sort of premier. There are many investment sort of firms that are above Merrill Lynch today. For really high net worth individuals, there are much smaller boutique kinds of firms above Merrill Lynch today. All right, so let's talk about incumbent versus entrant battles here, and talk a little bit about how you think about responding. Now, what we're doing today is we're taking a deeper dive on one of the routes to sort of disruption, one of the innovative strategies, which is low-end disruption. And Christensen describes it. You've got the performance that customers can absorb, the performance of a product or service. This is your bell curve of your customers. This is what the average customer wants. Some people want it for less, or want less performance. Some people want more performance. And you have a company that is moving up and increasing the technology that they offer in terms of providing performance on some sort of product or service. And the general idea is that sustaining innovations continue to move up along that curve, or along that line. Incumbents nearly always win if you come in and try and provide something a little bit better than what they're providing today, because they're poised to go that next step and to protect their current customers. So if a new entrant comes in and goes after Merrill Lynch's customers with something that's maybe what they think is a little better, they're gonna go after and fight for their current customers to not move to that little bit better product or service. What Christensen argues is that disruptive technologies come in at the low end and the performance isn't good enough for the majority of customers early on. But over time it gets better and better and better until at some point it becomes good enough. And this is the issue with E-Trade. What if it becomes good enough for enough people to say, yeah, it's convenient enough. With one, they give me 10 options of investment portfolios that I can choose from. I know what it's in. I just click on the one that I like, and I adjust it once every 3 months or 6 months, and it's easy enough. Why move to Merrill Lynch? And they demonstrate that my performance is as good as I get at Merrill Lynch somehow. Maybe that's convenient enough. I don't need a broker. I don't need a branch to go into. So what Christensen argues is that new entrants nearly always win when they start with this business model that is at the low end and then gradually move up market. All right, so let's think about low-end disruptive innovations. They target customers whose needs are what we think of as overserved in the market. What does that mean, overserved? Spencer?
So if I'm an average Joe, and I am an average Joe. I'm an average Spencer. And I don't necessarily need all the bells and whistles. And according with those bells and whistles comes a premium price. So if someone can strip down the product offering a little bit, have it more affordable, that'd be something that would be happy to.
Yeah, I don't need to talk to a broker. I don't need a branch to go into. And so you're offering me things that I really don't want to pay for, right? That's the notion. Price is more important than these additional features. So if the product performance become good enough on the basic things that I need, then that may be good enough for me to switch. The entrance has to use a low-cost business model. Now we're talking about business model, resources, and capabilities. The way they deliver, it has to be different activities so that they can actually make money on discounted prices. E-Trade, they don't have branches, lots of branches. They don't have lots of brokers. They don't have all of that. And so they don't have a lot of overhead that they have to support. All right. You've seen this already in the animation in a way that's much more interesting than what I can show here, but this is the basic Christensen argument around what they saw happen in steel, where the integrated steel makers let the mini mills come in at the low end, right? They gradually moved up market to the highest margin sheet steel, and eventually the mini mill producers knocked the integrateds largely out of the market. But we see this in a lot of other categories as well. So think about mini computers. This was DEC and Data General. When they launched early on, they were selling 250,000 computers at 45% margins. Personal computers come along. Well, they're selling for 2,000 at 20% margins. That doesn't look very attractive to a mini computer maker when you're selling one computer for 450,000 and you got 45% margins. You've got to sell, if you look at this, you got to sell 10 times to make the revenue and 20 times to make the profit of the personal computers. The problem is these got good enough fast enough that you didn't need a mini computer anymore because these could do whatever else you wanted. We see it in specific products. Take microwaves. General Electric was the leader for a long time. Then Panasonic, Japanese, come in. They're the leader. Samsung and LG come in. They're the leader. Who's the world leader today in microwaves? You probably don't know. Gallons Group, Chinese company. They sell more microwaves than anybody else today. Who's going to be next? We don't know. We see it with service companies. McKinsey, Bain, BCG Bain actually left the Indian market, in large part because Tata Consulting came in at the lower end, starting with consultants servicing all of their big conglomerate, all of their internal companies, paid Indian wage rates, but training them, they understand the Indian market. These folks are making so much less than the McKinsey folks that you can get a lot more consultants at Indian rates than you can at McKinsey rates. Here, you got to pay somebody $150,000, $200,000 a year for a consultant. Here, you're paying somebody $50,000 to $75,000 a year. That's a pretty big cost advantage. Brands can be disruptive. Brands create value when customers are not yet well served. But they don't create value when marketing to customers who are overserved. And what we're seeing is store brands coming in, like Costco with their Kirtland brands. That when the product, they can offer you a product that is good enough, people will switch from the name brand Centrum vitamins to Kirtland vitamins. A Jose Bank, shirt or a Brooks Brothers shirt to it. You don't know if this is a Kirtland shirt or a Brooks Brothers. They can do something that's good enough, people will switch. Entire companies in certain industries. So remember athletic footwear, how it started to move from country to country? Well, we used to do that here. Japanese companies did it, Korean companies did it, Chinese companies did it, in different industries. And you're going to have somebody new that's going to come along. Samsung just announced a lot of their smartphones are being produced where? Vietnam. They're moving 40% of the production over the next 3 years from China to Vietnam because Vietnam is cheaper than China. It was inevitable for many, many years. Everything's outsourced to China, but it was inevitable that someone would come in below China. Why? Well, because wages will increase in a country where you're selling more and more. What happens? Wages go up. Well, when wages go up, land prices go up. It's no longer, you don't have cheap land in China as much anymore. New technologies emerge for later firms to use to enter the market. Disposable income increases in China, and therefore mainstream customers want better performance. They're going to move up market and they're going to demand higher end products. Their companies will want to provide that. That leaves room at the low end. Chinese companies will pursue higher margin customers and this natural tendency to move upmarket. So, Merrill Lynch is here, and the question they face is this a disruptive technology? That's the challenge. And then when you are facing that as an incumbent, you now have to ask yourself, you know, are they going to get up here? Are they going to be good enough? And if they are, you're going to have to respond and probably take an option on the new technology. So the imperative for incumbents is going to be create or take an option on a separate new business model. Because, you know, that's a way that you can think about responding to something that comes in. And that really depends on the resources, processes, or capabilities. And Christensen likes to talk about values as well being important to what you're trying to achieve with the low-end business. And I just left you a slide here that sort of summarizes resources, processes, and values, which is sort of like the business model activities, research and capabilities you need to succeed in the new low-end business. All right. So let me just quickly say, Merrill Lynch actually in some ways is less disruptive than Schwab early on. Can you see that? Because Schwab has to respond immediately to E-Trade. At the same time, because Schwab has done business more direct with customers over time, in some ways they're better positioned with resources and capabilities to respond and move more to the sort of online space if they want to imitate. So there's this interesting dynamic. Just be aware of the fact that a new entrant comes into the market, and one incumbent may have a different response strategy from a different incumbent because they're in different places in the marketplace in terms of their strategy and their business model. It would be easier for Schwab to create something to compete directly with E-Trade because they're closer to that space than Merrill Lynch, who's much farther from that space. They probably would want to acquire or do an alliance, or you've got to figure out how to move up market. And you may want to do both. But that's really one of the issues for incumbents, and I wanted to do this case, is to make you sort of aware of what are the response strategies if I get this low-end disruption that comes in. What are my options? And you do have options. Then they're probably, if you really think it's going to take off, you probably either got to replicate it to compete. If you think, for whatever reason, you can do a good job of that, and maybe you even hire people from the startup and pull them over to help run it. Or you take an option in terms of creating an alliance with the firm. Maybe you buy 30-40%, figure out a way to help them grow, figure out a way to maybe connect them to your company, try and find synergies, but you keep all of the founders in place with skin in the game. You don't want to run it, or maybe you feel like you do need to own it, and somehow you're going to integrate it, so maybe you actually want to acquire it. Acquisition's a little bit tougher way to succeed if your business model is high-end, very different resources and capabilities from what you're acquiring. Because what you probably don't know how to manage this kind of business model. The founders started it, they know it, so you probably want to figure out a way to keep them in place if you can. All right, we'll see you on Monday.